step back and we can see that what really is happening here is a systematic removal of human intensity from finance. Just think about it. Until the late 1970s, hundreds of clerks used to write the futures prices on chalkboards and then record them to Polaroid film. Thousands of traders walked the pits. Accountants, actuaries, typing pools, administrators and human computers processed, calculated, deliberated and predicted. All gone. The start was Internet in the very late 70s into 1980, which could bypass the trading floor, quickly superseded by Archipelago and Bloomberg through the 80s. This then began to replace the floor traders. In 2000, there were 150,000 people involved in the securities and derivatives contracts in New York alone. By 2016, there were less than 100,000. And yet the market that they were serving had grown fivefold. So what next? What next of the new fund order for the next 20 years? Well, finance structures will continue to evolve. In this respect, the new fund order is unrelenting. Will technology companies simply just take over? Yes, but perhaps not in the way that we perhaps previously expected. I don't think Amazon is just going to come in and take over. It could, by the way. The balance sheet of Amazon is 300 times the size of Vanguard's. Amazon could buy Vanguard and BlackRock combined from its daily free flow cash flow. If Jeff Bezos wanted to. But I don't think he does, because he doesn't have to. There's a fantastic feedback that empowers technology companies because they dominate people's portfolios. They're among some of the largest capitalized stocks today. So they are already in your clients' homes. They're already on those portfolio statements. Also, there's technology firms who control the cloud, big data, AI, can change the asset management market at will from inside. They are your favored supplier, your data warehouse, your shared space, your co-op electronic messenger. They are everything that you probably use in your day-to-day lives as a finance professionals is already being provided by a firm that's probably already owned by one of the giants. If it isn't, and it's successful, it will be. But until recently, I was convinced that technology firms would simply just come in and take over. And then Cambridge Analytica happened. And what that did, what it has put big data in question. It's questioned big data from a fiduciary aspect, just as finances. Paul Smith, in his annual CFA address from Hong Kong, talked about a better brand of capitalism, a more purposeful model. And I'm warmed by that, because that's what we have to do. If we don't, then we will have failed, and investors will seek out technological solutions to replace us. Whatever happens, we will move towards clearing and settlement in a T0 scenario. We'll see new investment structures emerge. Traditional mutual funds will just quietly morph into these. I see a move from volatility-based risk ratings to the likes of pure style research or indeed Risk Lab. That move to factor analysis can allow us as buyers to ask new questions of fund managers to better understand how those funds in your portfolios are positioned for the current and for the next economic cycle. It allows you to better understand the risks in a holistic way and the drivers for fund managers behind their sales flows. Don't worry, Kev, I'll give you a little factor analysis tutorial later. We'll talk about this, right? In the future, factor analysis could even help drive new benchmarks. Sharing Alpha, as Kev rightly noted at the start, is the world's largest fund rating platform by number of analysts. In the space of 18 months, it has accrued over 1,500 fund analysts in over 55 countries. And it doesn't employ a single one of them. Playing the Scottish card, this is where Adam Smith's invisible hands help drive that competition between those fund analysts. You get positive benefits of aggregation, but also sharing of insights, community, and importantly, the analysis of those fund raters is tracked. Their performance, their hit rate. In doing so, by offering that independent, validated track record, becomes then a commodity back to those fund buyers. It becomes their shop window to say, I can select funds, and I can justify my outperformance relative to a series of benchmarks. Together with the likes of Fundhouse, I truly believe that Sharing Alpha is disrupting the fund rating space. Kev mentioned near the start of the session about the Association of Professional Fund Investors. I'm one of 3 directors of the Association of Professional Fund Investors. It was founded in 2011 by fund selectors, for fund selectors. Feel like I'm about to start the Gettysburg Address. Of the people, man. No, I'm not going to do that. The APFI is a non-profit organization. It's incorporated as a Swiss charity. It is global. We have members in the United States, in the Nordics, across Europe, in Asia, Australia, and now here in South Africa, led by my good colleagues, Red Daniels at GT Capital and Gandhi at Conceptual. Working heavily for 5 years on a due diligence questionnaire template, we sought to do one thing. Where can we find efficiencies in the due diligence process? Where is the commonality across the world between fund buyers and the information they seek? And how can we use technology to make that more efficient, faster, and work better for fund buyers? It led to Door. Door is one of the world's truly first eDDQ platforms. It's run by fund buyers for fund buyers. In every region, we have a guidance panel of fund buyers and APFI to ensure that the template incorporates the information that you need from your fund managers. What it does is it shortens the due diligence process rapidly. There's huge economies of saving here back to your asset managers. I also see growth in the likes of eRFP services like Invest RFP, Fund Info, and also search services like Fundbase and Murano Connect. I generally believe that eDDQ and eRFP will transform something that really hadn't changed for 20 years for us as fund buyers. FinTech will even give you solutions to your ESG conundrum. How, as fund selectors, do we gather data, analyze data, assess it in context to our fund managers, and try to address our principles of responsible investment? Because they are the questions we're being asked for now. How are we responsible investors? How well do we understand whether our fund managers have truly integrated ESG, truly have addressed areas such as environmental risk, sustainability, corporate governance, and the likes of Sustainalytics, South Pole, MSCI, FTSE have all created tools that can actually help you do that.